Thank you, everyone. Thank you to Richard and his team. They do an amazing job. In fact, I'm not sure if we've had an opportunity to do this just yet in this room. If everybody could give Richard and his team a big round of applause for a great job. All right, so as indicated by the title, $1 billion insights. When I was planning for this program, for this panel, I thought a little bit about our organization. I represent Equity Trust Company, and in helping to lead this organization, we have over $52 billion in assets under custody and administration. And so over the last nearly 20 years, I've had the privilege to observe billions of dollars flow out into real estate syndications, real estate partnerships all across the US, private money loans, private credit funds, cryptocurrency, even physical gold and silver. And so I started to think about what are the major needle movers in terms of our business allocating our capital? What are going to be the big wins for 2025, 2026 and onwards? And so I thought would be great for this panel, because we have a number of individuals, as you can see here, that have a lot of depth within their discipline, is for them to share what some of those big needle movers are. So that's my hope for the outcome of this panel. With that being said, we're going to jump right into it. We're going to go down the line and have each one of our panelists first give us their name, their company that they're representing, or companies, of course, and then and do this in under 2 minutes so we can get to the Q&A. And then from there, explain how can they best serve folks that are in this community and within this conference. So I'll start here to my left.
Myself and 4 other advisors manage $5.2 billion with a team of 27.
We have Pinkerton Wealth Management, Sherman Portfolios, a couple $1 billion RIAs.
Formerly, I was a consultant for a national consulting firm where I ran the family office practice. And I typically, work with a family, and what we do is we have strategies that benefits the G1 and G2.
We are a $9 billion multifamily office with offices in New York and in West Palm Beach. We have 75 employees. We serve about 110 families with a mean account size of $85 million.
We're an RIA wealth manager with $1.8 billion under management for 10 families.
We manage self-directed IRAs and located outside of Philadelphia, family-run business, looking to help anyone raise capital with their self-directed IRAs and retirement plans.
We're working with more or less 100 families, half of them U.S. and the rest international. We are advising today $18 billion in assets.
Excellent, thank you. So let's start with the first question, and we'll go down the row again, and feel free to expand a little bit more on this question. We want to keep it pretty tight so everybody has an opportunity. We can get the most value out of the panel. But the question is what do you see that smaller wealth advisors, smaller family offices can consider? We understand we're talking about $1 billion insights, but how can we take some of those insights that you've learned over time and individual investors, because there are some folks that are here that are on the individual investor side, how can they incorporate some of the same strategies that maybe you've been utilizing in a $1 billion business, but on a much smaller scale? I'll start here to my left.
So I guess a couple things. One is I think smaller advisors don't look hard enough at business owners and their needs and potential for exits. There's a lot of liquidity, and exits are top notch right now. I also think that alternative investments, even if you're not qualified as an accredited investor or a qualified purchaser, you can use liquid alts. If you look at the NACUBO, the National Association of College and University Business Officers 50-year study, which came out this last February, the average 70-30 asset allocation is morphed into 53% in stock, 26% in alts. And I don't think that they're being used enough, whether they're large advisors or small advisors.
Excellent.
So we focus on completely liquid asset classes, like Buffett has 100% in his portfolio liquid. In our one RIA of $1.5 billion, it's entirely liquid. Another $1.5 billion is entirely liquid with the research firm. And then we provide research for over 600 investment firms, advisors, hedge funds globally, and we're looking at scalable strategies and trends that they can also implement on a liquid basis. So there's another about $10 billion that they're overseeing based on our strategies there. And what we're looking at as we every week are screening out 25 different asset classes and sectors to see which ones are trending upward as compared to the Russell 3000 index. And those that are trending higher, we tend to weight more towards, like a year ago, is more towards technology. Right now, technology is number 10 on the list. There's higher ones on the list. We're focusing more on energy and travel, those areas that are favored really with the new administration as well. Typically, we see a safer global environment. So the Royal Caribbean's up 100%, and Tesla's up 70%. I showed yesterday what stocks were invested in with our top 20 out of the S&P 500.
Excellent. You brought up, Dan, you brought up energy, and that seems to be a common theme across several panels that we've had over the last couple days. And so on our next panelist, if you wouldn't mind, if you have an area of expertise within energy, if you could maybe scratch away at that a little bit more, as well as the rest of the panelists that comment, but I'll have you go ahead.
We're a single family office. We take a look at a lot of investments. We're probably 80% liquid. Energy is very much on our mind. We're looking at it as we're a big investor in AI, and energy is going to help AI go forward. I think the opportunities that energy, they're out there, but I'm saying some of the new stuff, some of the stuff that's out here today. And, you know, don't be surprised if you see a lot of nuclear coming up again.
Excellent.
So of our $9 billion, about 40% is in alternative investments. So it's hedge funds, private equity, co-investments. And I'll say something unpopular. The smaller advisor can't get the same access that we have access to. We just can't. And if you do, you have to ask yourself the question, why am I so lucky? And the truth is, probably a lot of other investors passed on it already. So I would just say you need scale, you need experience, and you need connections to have a proper alternative investment program, which is what I think is necessary to manage, $50+ million portfolios. That said, if you're a small advisor, I would absolutely always have a direct indexing program, which is essentially creating an S&P 500, a personalized S&P 500 or any index, a personalized separately managed account of an index, which can do tax loss harvesting. And these programs are available at many brokerages and many asset managers for really, really low prices, like 20 basis points, something like that. So small guys can do that too.
Quick follow-up on that, and then we'll move to the next panelist. With respect to alternatives, and in my world, representing a trust company, and we see individual investors, true retail investors, participating in alternative investment opportunities, whether that's through a fund or a direct investment, could even be like real estate or a private money loan. But for these, I'll see alternative opportunities that are out there through all these different technology-based platforms. Those particular opportunities in comparison to what you're talking about, can you comment on what some of the differences are and what an individual retail investor might think about when they're looking at, the types of alternatives that you're talking about compared to some of those sort of shiny object alternatives I'll talk about that are out in the marketplace? And the rest of the panelists, I'd like you to comment maybe on that as well, in addition to the energy question, but go ahead.
Okay. So I think maybe what you're talking about is the democratization of alternative investments and private equity. And, I think what happens in some instances is that you have greater liquidity to match the needs of the retail investor, but there's an offset for that. You're not getting the true investment, I don't believe, because we're willing to trade a lot away for illiquidity, but I'm hoping to earn, at least 500 basis points per year higher for that as an illiquidity premium. I think I don't know a lot about the smaller investments and the technology platforms that might enable that, but something has to give there. You can't provide the liquidity. All of our clients are qualified purchasers who meet all the eligibility requirements, and we can lock up capital for a long time, and we're happy to, in expectation of a much higher return.
Excellent.
I'd have to agree. For larger families, they typically create their own funds, in the terms of the private equity, they invest in direct deals. And they do it sourced through the ecosystem that is the wealth management firm that they deal with, other 150, 200, $250 million families. And that's a sourcing that the smaller ones typically don't get at first cut. That's just the reality. In terms of the liquid, I would agree with the former colleague, except I would look at also actively managed ETFs, or let me say thematic ETFs. So for example, we found free cash flow as the best value metric in certain economic environments, so we invest in that. We like Asia outside of China. Difficult to do on a long only because everybody's benchmarked to the ACWI, which has a large China component. And finally, on the energy, the only thing we're doing right now is data storage sources, but we're doing it from the energy source first, which is liquid natural gas access to the grid, and we're just building the centers right next to the energy source. So we're not building a source and then putting energy. We're starting with the energy source first and then building the building next to it.
Excellent. So that's the answer to the energy question.
All three.
Excellent. Appreciate that.
Yeah, thank you. No, I'm going to speak to the platform that you had mentioned, that some of these investments are opportunities to the lower level. But I agree that if somebody's coming to an investment that has already been passed, they have to wonder why, and they really should do due diligence. I can't overemphasize that with where we are in the alternative investment space, that your due diligence is very important to do it. So even if it is on a platform, if it's left over, your due diligence is expected.
Excellent.
We are a little bit different, and I think this is really important to explain, because we are a non-discretionary company. So most of our process is really to empower the families in order how to make decisions and how to learn and educate themselves in order to understand where they're going to invest in. Working with a handful of families is much easier really to create an investment committee for them with a process, with an agenda, with minutes, etc., and sharing with them the opportunities that we think could make sense for them. And they go through a process and learn and decide to make it or not. They don't need really to be a specialist, but at the same time, they find and they learn how to invest. Getting into the alternatives, we believe very much in the long-term investment and dealing with families that they will not be able really to spend their wealth in their whole life. They really have a much longer term to invest and to really be able to implement their strategy. So we are quite heavy in alternatives in general. And in both, we believe in the hedge fund space. The last few years has been extremely good to lower volatility, and in the private space in general in every single sense. And getting into your last question about energy, we think that probably one of the best opportunities is still in the traditional oil and gas sector. So the institutional money left. So at the same time that the companies need capital in order to keep investing, and they don't have it. So you could really get very good partnership with these companies in order to really to explore the wheels and really have extremely very high cash flow returns in the traditional oil and gas, and of course everything that will come with nuclear and other things, and to create the grid again, etc.
Interesting. I've heard nuclear come up twice on this panel, which is fascinating. We should probably maybe next year, Richard and his team, write it down. We need a panel just on nuclear energy. All right, so with that, if it's okay, we're gonna go ahead and switch the page to real estate. So I know something that a lot of people are eager about right now, and they wanna know from experts like yourself, is how you see real estate playing out in 2025, 2026. And obviously we can go down the path of interest rates and a number of other variables and facets. And some of you may have more or less experience in real estate, so feel free to gauge the time of answering this question based on your experience level, but I know that there's experience on this panel. So the question to all of our panelists here is, just what do you see with respect to real estate, with the debt crisis that we're approaching? What are you doing within your business and within your wealth management scheme in order to address what's going on in the real estate world? I'll start here.
So I work with a lot of family offices, and my task has been really since 2015 to try and talk family offices out of what made them rich, trying to rebalance them. And those that are in real estate and don't like Wall Street, or those that love Wall Street and really aren't flavored towards real estate, to bring them into the middle. So that's always a challenge in working with larger families because they have knowledge bias of what they know and know well. And I know everybody's shaking their heads going, yeah, we have the same problem. As a Wall Street private equity guy, we have the usual suspects that are available, but it wasn't really until 2017 that we had Delaware statutory trust availability so that we could do some work from Wall Street to help rebalance estates, and that is growing very, very quickly. Not only the income style, but there are some with 20-year terms that provide cash back called a refinance. And so I think that's a solid part of what will be our future going forward. There's a lot of people in this room with great real estate who are here talking about doing their developments and others. That won't stop. I think that in our alternative investment desk, our private institutional client desk for clients 50 million and up, we did 11 months ago, 4 weeks ago, and this next week, the SpaceX raise for their employees. And on that desk, I have 2 that I'm bringing to that desk for next year. Only 3% of that desk is in real estate. And it's because most of those families at 50 million already have a lot of real estate. So our opportunities are a little more limited than many of the other panelists here.
You mentioned DSTs, and I can speak to this a little bit. As representing a qualified intermediary for 1031 exchanges, we're starting to see more of those flows as well. We're a little bit smaller intermediary, maybe in comparison to some of the larger ones, but is much of that catalyst from individuals selling real estate and trying to defer their capital gains in those
actually from institutions. So we have 2 on our alts desk. They're very large billion-dollar operators, and the way it works on the street is a little bit different because you'll actually have your 10 million sale, 5 million basis, and you'll sell it for 10 million, bring it into the DST, and you're actually investing in real estate during the first year that you own. At the end of the year, your IRC 721 uploaded or upreaded into the $2 billion fund. And so almost all of the top 6 or 7 on the street have these availabilities now, and they're very large operators. I think there will be more, and one of the IRS letter rulings was that 10 million sale at the end of the second year in the UPREIT, you get to remove your original principal or your original basis of return of principal. So institutions drove that first, but I think that the common investor and private individual are picking up on it very quickly. And there's a big difference between good operators and bad operators. Anyone you do business with, make sure they've been audited by the IRS and no findings would be my recommendation.
Excellent. Appreciate the tax efficiency conversation there. A lot of value. Real estate?
Sure. In regards to real estate, there's been some concerns out there as well as the banking industry and how that's, what are our thoughts in this coming year regarding the banking institution. And out of the 25 different asset classes and sectors that we track, banking is one of those 25, and it's currently rated number 3. So I don't have much concern for the next year in that regards. And for real estate specifically, it's at number 18 at this point. So it's where the Russell 3000s that'll right after 10. So there's 15 that are underperforming the market. There's 10 that are outperforming. And as it relates to the 10th one, which is technology, even our technology stock that's been there for a couple of years on our top 20 list is NVIDIA. And it's still up even 70% year to date. So we have nothing in real estate right now in our liquid portfolios because how is it going to be able to compete with our number 10 on the list of like NVIDIA at 70%?
Gotcha.
Yeah, our family, we've looked at real estate, but because the same thing Dan just said, we're getting such better returns on the other alternatives, and the family has a lot of real estate. So when they look at real estate that they own as a family, the only time we do real estate is through a fund-to-funds alternative. But I think real estate takes a specific amount of expertise, which is something this family doesn't want to do.
We've generally shied away from real estate recently. I mean, but of course, when you say real estate, are you talking about multifamily, where there's a dearth of supply in many markets? Or you're talking about office space where there's ample supply, right? I mean, are you talking about Austin, Charlotte, or New York? So you can't just say real estate. It's many. It's local, right? The real estate's local. So there's many different subsectors. That said, I'm actually, we think that rates are going to be higher. And I think if rates are higher, that's not good for real estate. And, so I would be buyer beware.
Excellent.
What we like about real estate is return of capital as opposed to return on capital. You get your money back in a few years. To my colleague's point, though, you really have to differentiate. We want to see something that's really specifically differentiated, like workforce housing or something that other people don't necessarily have, because there's so many multifamily office opportunities throughout the U.S. Just one point on the banking. We are concerned about the CRE loans on the banking sector, but we're much more concerned about the available for sale and also hold to maturity bonds on the balance sheets of banks. If rates do go up, there's going to be a problem. Banks can make money because the yield curve's positive, but they're going to lose on the mark to market if there's going to be a run on the bank or so on, because some of those banks are much more exposed. So it's sort of a redux of what we saw with Silicon Valley, but now focus more on the real estate. So that's what we're concerned about.
Excellent. Appreciate that.
Yeah, no, I agree with the debt crisis. I don't think it's going to be full spread, though, across the board. I think you're going to see maybe some banks that are backed by commercial real estate, that they're going to have some problems. I happen to love real estate. I'm a third generation real estate investor. I can't get away from it. So I could argue the point, yes, but the commercial real estate that we have is not doing as well. But that's it.
We think at this point probably the best opportunity in real estate is much more investing in the debt part than in the equity. Really, I think we will see a big amount of maturities coming in the next 18 months, the 18 to 24 months, and really they will need to be refinanced, and you could really have a double-digit returns in the debt part without taking the equity part, so much lower risk.
Excellent. Okay, so we're going to have two less than 2 minute sort of fire rounds, if you will. We'll go all the way down the row and all the way back. So first question is, again, this is for all panelists. We'll go down the row in less than 2 minutes. Is what is the number one counterintuitive lesson that you've learned that you wish you would have heard on a stage like this, let's say 10 or 15 years ago? Start here.
I think the audience would be shocked to hear that the thing I'm doing the most for right now is raising liquidity in the secondaries market for wealthy families. Liquidity has been really tough for the last couple of years. The big four are not doing this anymore. I get a call every week from a venture capitalist who has a fund or a private equity group or a couple of families that have vintage maturing PE or VC asking me to do liquidity raises. We do them 25 million special purpose vehicles, both private equity and private debt. And I think right now, if you asked me 15 years ago if that would be a predominance of what I'm doing right now, I would be shocked.
Counterintuitive, trust the trends, not your emotions. Most people are driven to make decisions based on their emotions and investments based on fear and greed, and they tend to then sell when they should be buying and buying when they should be selling. It reminds me of when I was born and raised in Alaska. The only fishing I knew in Alaska was we would drive half a mile to the largest float plane lake in the world, Spinard Lake, and we'd get in the Cessna 172, go fly 20 minutes until there's a bunch of rivers, and we could see where the salmon were, where the rainbow trout were, and where nobody else was. We'd land, catch our limit, go home and eat it. And so that was a pretty cool way of life. But as we were going to and from, there'd be some big clouds along the way, and Dad would just put me right in the middle of the cloud, and it's completely white. And the only way that you will know if you are upside down or right side up is if you trust the instruments. And so in the investment world, the instruments are the trends, and our patented research we trust because it's been through the battle tested through the trenches times where we don't trust the emotions, but we trust the trends.
Excellent.
In investing for a family office, I think there's two things that people, and I've really paid more attention to lately. One, know your family, know who you're investing for, know what their goals are. The other thing is, do not forget taxes. Taxes and tax efficiency play such an important part in all your investments, and understand all the aspects of it. Most of the families that the people on this panel represent have very complex tax structures. You need to understand how taxes affect those and how they flow. Someone mentioned earlier, like tax loss harvesting. You got to take a look at it. There are some great things out there with tax-exempt yields for these families that are worth a lot with a lot less risk. So you just really have to understand the taxes because that will add a lot to your returns.
Yes. Good answer.
It's not, it may be counterintuitive. So, I mean, I work with a lot of families that are $100 million and they seem like captains of the universe, but they're human. And that's the counterintuitive thing to remind yourself is that they have FOMO, right? And you know, the guy who they play golf with invested in NVIDIA, at $2, something like that, so there's FOMO. And even when we set up investment plans during rational times, sometimes the market gets irrationally exuberant, and clients can sometimes get irrationally exuberant, and we just have to be calm. I'm deeply unemotional about the way I invest capital for my clients, much less so for myself, but that's because I'm human.
Excellent.
Yeah, 10 years ago, I wish I'd known more about investor psychology, because the investors themselves, the investors we have, first generation, 10, 15 years ago when we started with them, they themselves are different people now 15 years later, and their children are all different people that we don't necessarily know. And we assume they go with one, but we have to deal with the investor psychology. And on the counter of the FOMO is the paranoia that occurred in 2020 with COVID, where people said we want to get out in March. We said you do not get out in March. Everybody's rebalancing on March 31. All the pensions are going to have to rebalance up. Don't get out in March. It's their money. They got out in March. So the psychology aspect is something that we underestimated when we started.
Good answer.
The biggest thing, if I could think back, is there's opportunity in every economy. And we have thousands of clients that I've witnessed, and COVID as an example, everybody's buttoning up, not spending. We had clients going out and buying 10s and 20 houses, single family houses at that time in South Florida, where, I was looking and I'm waiting for it to drop even further. And now those same houses are, 5 times the amount that they were during COVID.
Probably I would have tried to learn and invest much more in family governance, because really the main problems that I have seen working with families came from a misunderstanding among the members of the family. Not so much about the bad investment or if you make a much better return than the other one, but really the families part and finish the thing that when they are together, when they really have a problem of understanding or they have a totally different view of how to do things in the future. So I would really dedicate much more time about that than I will really try to get the best performance in one specific investment.
Excellent. 2 common themes I'm hearing is logic, not emotion. And then number 2, great answer on tax efficiency. I like to factor in tax efficiency into the actual return on investment, which I don't think is done enough in the financial services industry. Maggie and I, representing trust companies, we deal a lot with Roth IRAs in particular and HSAs, and these are tax efficient vehicles that individuals are utilizing and I think are very undervalued and underestimated at times. All right, last question. We're probably going to need to do this 1 minute each because we're running a little bit short on time. But what's the number one takeaway that you want people to hear from your area of discipline? And then just wrap up with, how can people find you? Should they come to an exhibit booth that you have outside, or just look up your information, find you on LinkedIn? So try to get that done in under 1 minute and 15 seconds. I'll start down there.
I would start just a very basic one: diversify, and really I think we are in very hot market today, and it's very difficult really to maintain this kind of returns for the long term. So you need to rebalance once in a while and try to find diversifiers for your portfolio in order to reduce risk.
And mine would be to, if you're looking to raise capital, I've met a few of you that are struggling to raise capital. I'd love to show you how to do so with qualified plans. And by that, it means retirement plans, tax-free in a Roth or an HSA. And I can be found on Hoover or LinkedIn.
Excellent.
If you're trying to raise capital, put yourself in our position. We get 100 a week, short, to the point, Don't ask for the business. Add value. Find the trigger in our responses. I think we all generally are pretty good about responding because we don't have a monopoly on all our good ideas. So add value, slowly be the go-to person when we do finally begin to look at your sector because you've been giving us good information. And you can see us on LinkedIn, Artemis Wealth Advisors.
I just look at the overall market, realizing that it's up 60% in the last 24 months. It's as Santiago said, it's not sustainable. That said, markets don't die of old age, So I think the market will return more toward rationality. In fact, I'm 100% confident in that, but I won't tell you when because I don't know it. But I agree with diversification, and one needs to allocate away from industries and sectors that are mispriced. My firm is Tag Associates, based in New York and West Palm Beach, and you can find us on the internet.
I would tell you diversification is key today. Also, I think liquidity is more important today. But the one thing that I'll leave you with is technology for small family offices, small investors, for the investors we represent, has come so far, and it can help you do your job so much better. Don't underestimate technology, because technology, it can give you better tools, help you do your due diligence, give you better tracking for your clients and your families. So really pay attention to technology, and it's really the prices of it have come down, and it's come a long way.
Trust the instruments, trust the trends, not your emotions. I agree that the current trend with our top 10 up 36 to 60% in a growth market is not sustainable. So you should have all the different features of the Ferrari in your portfolio, so you know when to kick into reverse gear. You know when to hit the turbo boost button like we have for the last year. You know when to be adding the skid control and the anti-lock brake systems that we've patented. If you want more information, of course, you can see us at the booth. If you want to ride in the Ferrari, then you get to investor minimum.
You also win the award for the best tie on the panel, so thank you. Finish up here.
I think most people who know me as a public speaker and a person you can find. I'm on LinkedIn and a bunch of places. I manage portfolios for our high net worth family offices and foundations. But the other half of my job is working in our investment bank. So for those startups in the room, when you get to 4 million EBITDA, 30 million valuation, I push you through to the investment bank for a growth capital raise, exit, or ESOP. From 0 to 4 million, you can still call me. I'll try and get you into some angel and other places to help you do your raise, because we're not permitted to do that. I also am a contributing writer to Family Office Magazine. I author the quarterly Tales from the Street. You can find me there as well.
Excellent. Appreciate it. And last but not, we have an exhibit table outside, IRAs and helping capital raisers. For those that are out there raising capital, working with investors, deal sponsors, there's over 14 trillion in IRAs. And then when we account for pensions and 401ks, we're looking at close to 40 trillion. And there's less than a billion that is actually in, well, I shouldn't say less than a billion, I should say less than $1 trillion that's invested in true alternative assets. So that's something to consider as well. I think we might have time for one question. If there's a really good question out there for one of our panelists, right here. I'll repeat the question if you can.
Hello, great insights. I'm a speaker tomorrow, and I'm sitting here scratching my head. I'm not promoting this publicly. I'm like, how do I reach out to the different families to see if something we could do together? That's all. What's the best way of starting the relationship versus going up there shaking hands? Is it the website?
I guess I don't understand the question. Are you saying that you have access to some shares and you're looking for an outlet for them?
If a group wanted to start a relationship to present an offering or figure out what opportunities you guys are doing, what is the best way to start that relationship?
Just give me a call and I'll walk you through what we can and can't do with the investment bank. Happy to help.
Go ahead.
It's tapping into the ecosystem. This is already occurring between wealth management firms. We all have colleagues in the business, so we have a block of something that's available for one client. This is happening, point one. Second, I think NASDAQ has a new program coming out. the secondary people are active, but you need to get into one of the ecosystems. And quite frankly, this is probably a pretty good place to start.
All right. Well, I know Richard Wilson likes to run the Family Office Club like a well-oiled machine, if you couldn't tell already. So we're going to stay on time. Let's give our panelists a big round of applause. Thank you.
Join the Family Office Club by visiting familyoffices.com. We look forward to seeing you at our next live event.